So we're going over the risk and cost of capital. This is chapter 9. And this chapter is essentially going over how do you measure risk, measuring the cost of equity, analyzing project risk, and adjusting for risk. What is the firm? So firm value is basically the present value of its various assets, right? So you could have different cash flows they could have different business opportunities, they can have a certain market share. All this has some kind of asset, all this is some kind of earnings, and these earnings will eventually come in. So we have to think about what is the likelihood of these earnings coming in, and the present value is the firm value, right? But the main two variables are, in terms of a firm value, is what are the earnings, right? When are they coming in? And what's the risk rate? Because we discount by the denominator, right? So when we look at the CAPM, we can see company's cost of capital, and this could be, in other words, the risk rate compared to beta. So what's the project beta? And you can kind of see when do you take it, when do you not take it in terms of the project risk, right? So a company cost of capital, another way of looking at it is looking at what is the rate of debt weighted compared to total value, and what is the cost of equity compared to total value, and this could be the total company cost of capital. Now, you may have seen in the news in general, last couple of years, a lot of debt issuance. Even most recently, there was a case with WeWork, which I recommend you look into. It's actually been going on for about a year, and then maybe going on for another year. But they wanted to go on IPO, which means they wanted to actually issue the equity piece. But then what happened was the market said no. It was supposed to be a $40 billion valuation. It went down to $20 billion. And now SoftBank is, negotiating with them, trying to actually, I think, buy them out at the valuation of $8 billion via debt. So they're actually investing via, a debt package. So what does it mean to have debt versus equity? They're both funding sources. And of course, the cost can pretty much vary. But these are the two main funding sources. And sometimes when you can't raise equity, you're going to try to raise debt. But both will try to evaluate how much are you going to pay back and what is the right risk rate to charge you, right?